How many investments should you have in your portfolio? How many ETFs or mutual funds? That's the question we're going to tackle in today's video. We're going to talk about the simplest portfolio that I can think of that gives you broad diversification. And then we're going to talk about 5 reasons you might want to consider actually making that portfolio at least a little more complicated and involved. So let's dive right in. And I think as a starting point to building any portfolio, we want to come up with one that's got broad diversification that covers all of our bases, or at least most of them, in both the stock and bond investment. So how can we do that? Can we actually do that in just a single mutual fund? Well, sure. One option would be a target date retirement fund. The one I want to show you today is not actually a target date fund. It would be called a balanced fund. It's offered by Vanguard. And here it is. It's called Life Strategy Funds. And I'll leave links to everything I show you below the video. And they have 4 of them, I believe. Let's see. Yep, they've got 4. And you can see over here, they have different allocations between stocks and bonds. The most conservative here, 20% stocks, 80% bonds. And it goes up to the most aggressive, 80% stocks, 20% bonds. And we could invest in just one of these funds and get tremendous diversification. And here, it's really important to keep in mind, I'll say 2 things as we go through this. The first is the number of funds we own tells us nothing about our diversification. I've seen fund portfolios that advisors have put together with dozens of different ETFs, and these were no more diversified, and in some cases, a lot less diversified than this single life strategy fund that I'm showing you. It really comes down to what each of these funds invests in. We'll look at life strategy in just a second. But the second thing I would argue, and this is a bit controversial, is I don't think it matters how much money you have to invest. You could have $50,000, $500,000, $5 million. You could be sitting on $50 million, and I think a life strategy fund, as just an example, would be a perfectly reasonable approach to investing any amount of money. So let's take a look. So we'll just look at the one that's the most aggressive, 80% stocks, 20% bonds. All of these 4 funds invest in the same thing, just in different percentages. And if we scroll down, we can see how they have this money invested. They put it in 4 different Vanguard funds. Here they are. And so they've got, this is just a total U.S. stock market fund. This is like a VTI, is an ETF version of this. They put $48, every $100 you put in, they're going to put $48 in this fund for you. They're going to put just over $32 in the international fund. Again, very broad-based international fund. And then they're going to put $13.60 into, this is effectively similar to BND, which is a total bond ETF that Vanguard offers. And then they're going to put a small amount, 6%, in an international bond fund for you. So you don't have to actually allocate it to each of these funds. You simply buy, in this case, VASGX. You put your money in that fund, and they're going to divide it for you into these 4 funds. They'll rebalance for you. You don't have to worry about rebalancing, and you have broad exposure. You own thousands upon thousands of stocks and literally over 10,000 bonds. And just to show you that, we can look at this fund right here. We'll look at the ETF version. So I just put in the ticker for the ETF version. I'm going to go to Portfolio. This is in Morningstar, a free tool. And it'll tell us what they own here. Let's see. There we go. So that one fund, 3,714 different stocks. And that's just the first fund. There's even more in the international fund, I'm pretty sure. We can double check. I'm pretty sure that more or less tracks what's also VXUS. And we'll go to Portfolio. Yeah, this has got 8,500 stocks. So we're over, with this single fund, we get exposure to over 10,000 stocks. And I can tell you in terms of bonds, there's like 15,000 bonds just in the total bond market fund. So you get incredible diversity in one fund. And you basically cover the market. You don't own TIPS, Treasury inflation protected securities are not included in there. And I suppose you don't own high yield, or otherwise known as junk bonds. But other than that, you pretty much own just about everything. So now the question is, why would we want to complicate things? Why not just all use life strategy funds? Or if you preferred a target date retirement fund, that might be another alternative. Why not just keep it simple? And there are some reasons, I think, some good reasons why we might want to complicate it a little bit. The first is a very practical one. You may have a workplace retirement account, 401k, 403b, perhaps the TSP, and you're looking at the fund I'm showing you and you're like, Rob, sorry, buddy, but my workplace retirement fund, it doesn't have this option. I can't invest in this. It's not in there. And you might not like the target date retirement fund. So very practical reason is, at least for some of your accounts, through your work, it might not be available to you. So that's the first reason we might have to go somewhere else. But now let's imagine we could, rather than investing in the life strategy fund, we could pick these 4 funds or similar index funds, doesn't have to be from Vanguard, and we could just invest in these 4 sort of on our own, and we could, pick the percentages that we wanted. We wouldn't have to put 48% in the US total stock market fund. I don't know, maybe we want 50% or 60% in that fund. But the point is, we could choose the allocations not between these 4 funds. And that really gets me to the second reason we might want to complicate things. We don't like the percentages that Vanguard in this case, or target date fund, same issue, they've chosen, right? So for example, when we go back to the life strategy funds, remember, there were only 4 overall options. Well, we might look at this and say, well, I want 100% stocks, or I want 70-30 or 75-25. Well, those aren't options here. And then again, within one of these funds, we might look at it and say, and go back to portfolio composition, not only do we want to change the stock to bond allocation, but we also want to change it within it. For example, we may say, I don't really need international bonds, so I'll get rid of that. And that leaves us with what you may have heard of called the 3-fund portfolio. That's what these 3 funds are, effectively the 3-fund portfolio. And you may say, that's good enough for me, don't need international bonds, and then I can choose stock bond allocation. I can choose how much I put into US stocks versus international stocks. And to me, that is a very good reason to, I'll say, complicate in air quotes, because going from 1 fund to 3 funds is not really all that much more complicated, but it does complicate things, and you now have to rebalance on your own between those funds, so there is a little more work. But to me, that's a very good reason to complicate the portfolio at least a little bit, moving beyond 1 fund. But notice, it doesn't require that we invest in 10 funds or 20 funds. I've seen portfolios advisors have put together with 30 or 40 different funds. Absolutely absurd. We don't need that. 3 funds and you have an incredibly diversified portfolio. Now, are there other reasons that we might want to sort of complicate things, but not too much? And sure. And I'll show you another one. If we look at, we'll stick with this life strategy fund, you'll notice that it has an expense ratio right here of 14 basis points. Now, as funds go, that is incredibly inexpensive. That's just, 0.14 of 1%. That's very inexpensive, but there is a cost involved of having Vanguard do all this rebalancing for you and simplifying things down to just this 1 fund. If we look at individual funds that could comprise that, we looked at VXUS, we go back to the quote, you'll see that this is really inexpensive. It's just 8 basis points. And if we go back to VTI, it's even cheaper. It's just 3 basis points. And if we go to B&D, which would round out, say, a 3-fund portfolio, let's see what its expense ratio is, just 3 basis points. So that's a third reason we might want to at least complicate the portfolio beyond just a single fund. We can save some money. Now, we're not saving a ton of money, but as we know, even 10 basis points compounded over 20, 30, 40, 50 years will really add up. And so we have to decide for ourselves, do we prefer the simplicity of something like a life strategy fund, and we're willing to pay a little bit more so that Vanguard or Fidelity offers similar funds, Avantis offers similar funds, they can deal with the rebalancing, or do we want to save that 10 or sometimes 15 basis points to do it ourselves? But I think that's a really good reason to, again, somewhat complicate the portfolio to save money. Now, there's a fourth reason. Let's go back to life strategy again. Remember, whichever fund we pick, it's going to have some amount of bonds in it, right? The most aggressive fund they have is this one, and it's 20% in bonds. And so why does that matter? Well, It comes down to asset location. I prefer not to hold bonds in my taxable accounts or my Roth accounts. I prefer to stick with stock funds in my Roth accounts, and in my taxable accounts, stock, and then to some extent cash. But for bonds, I'd much prefer to have those in a traditional retirement fund, like a traditional IRA or 401k. And if all I choose is a fund like the Life Strategy fund you're looking at, or a target date retirement fund for each of my accounts, I don't have that control. And that's really important to me. Now, I could stick with Life Strategy funds to some extent in a retirement account, although even that I couldn't. But you could go with something like VT, which is Vanguard's Total World Stock Fund. You could almost think of this as a Life Strategy fund without bonds, okay? And if we go to the portfolio, we can see it's about 60% U.S. equity and 38, we'll call it 40% international. There's actually a bit of cash. And so you could imagine a portfolio where I use this fund in my taxable accounts and my Roths, and then in my traditional, if it were available to me, a Life Strategy fund or perhaps a target date retirement fund, which is probably more likely to be available in a workplace retirement account. Maybe not from Vanguard, but hopefully still a good one. And I could pick the target date retirement fund so that it had the stock bond allocation such that when I added in my Roth accounts with, say, VT, all stocks, and my taxable accounts, I got the overall stock bond allocation I wanted. So we could do it that way. And if we wanted to even complicate it a bit more, instead of VT in taxable and Roths, we could have a total U.S. stock index fund and a total international stock index fund. Yeah, it complicates it a little bit, but that then allows us to pick how much is in U.S. stocks and how much of it is in international stocks, which may be important to you, but it allows us to get the asset location we want, keeping bonds out of our taxable accounts and our Roth accounts without overcomplicating the portfolio. Again, something we couldn't do if we just picked a Life Strategy fund or a target date retirement fund for all of our account types. Now, the fifth reason, and this is the one that probably gets the most attention, the fifth and final reason we might think of complicating the portfolio, let's say beyond a three or four fund portfolio, would be we want to overweight a certain type of investment, or we want access to a certain type of investment that we don't otherwise have. Now, that's pretty rare, but the one standout exception in my mind are TIPS. With a lot of target date retirement funds and Vanguard's Life Strategy funds, you don't have access to Treasury inflation protected securities. So you might say, I really want some access to that. I want some exposure to TIPS. So that would be one reason to complicate the portfolio. Again, it's not an extreme complication. It's literally adding one fund, but it would give you exposure to TIPS. But you also, a lot of people do, they want to overweight something, meaning, and all that means is they want to invest in a certain type of stock or bond in amounts greater than the overall market. So what would be an example? REITs. So in this fund, we have access to REITs because REITs are in, for example, the total U.S. stock index fund. There are REITs in that index. So investing in this fund would absolutely give us exposure to REITs. And in fact, we could look at it, it'd be easier to see it if I just go to VTI. And again, we go to portfolio and we'll see sectors down here. And there's real estate right here. Now, it's not a large exposure to real estate, 2.7%. And that's kind of the point. Some people will say, Rob, appreciate that. I want to keep things as simple as possible, but I really want more exposure to real estate than what a total U.S. index fund would give me. So if you're going to do that, if that's important to you, then you need to add another fund to your portfolio, add some kind of REIT. Vanguard, of course, offers a REIT index fund, but there are many others available. And you could add REITs. Other popular overweights would be in technology. A lot of folks like to have some additional exposure to QQQ. I can tell you, I'm not one of those individuals because if we look at VTI, it already has a pretty healthy exposure to technology because those are the larger companies in the U.S., so we're already at 30%. But Some people want additional exposure to technologies. Others want additional exposure. And a popular one is small cap companies value. That's a favorite of many and was of mine for many, many years. Other folks like to maybe have some overweight in emerging markets. And so you could try to overweight your portfolio. And to do that, you're going to have to be adding funds. So if you want to overweight technology, REITs, small cap value, and emerging markets, well, you've just added 4 funds to your portfolio. And so you have to decide for yourself, is it worth it? Is it worth the added complication? Is it worth the added maintenance that's going to be required to keep track of all of this and to rebalance from time to time? And so in my earlier days, I ended up with about 5 or 6 funds because I did overweight small cap value. I added REITs and I added emerging markets. And I did that for probably 20 or more years. As I've gotten older, I don't know if I've gotten any wiser, I've found it less compelling. And I've tried to simplify my portfolio. So I've gotten rid of overweight to emerging markets and REITs. Again, I don't think overweighting those is a bad decision. I just decided that what was more important to me was simplification. Now, I mentioned 5 things, but I do want to throw in a potential, I'll call it a bonus reason, but it's one that I don't feel is all that compelling, but I hear it a lot. And that is, if we go back to the Life Strategy Fund as an example, if this were the only fund we owned, there would really be limited tax loss harvesting opportunities, assuming we held this in a taxable account. I suppose if we invested a lump sum and the value dropped right away, we could sell it, wait 30 days before we bought it back, and we'd have some tax losses. But what I've heard the argument says, look, if you have a strategy with 6, 8, 10 funds, it may not, in the end, look much different than Life Strategy. It's just that rather than having the convenience of one fund, we've broken it out into a half a dozen or a dozen different funds, which we could easily do. Then it's more likely that we'll have some tax loss harvesting opportunities because some of those asset classes will underperform others, and maybe we'll have some losses, and we'll have a greater likelihood of tax losses that we could take advantage of. I think that's certainly true. My view is if there are tax loss harvesting opportunities, it may make sense to take them, but to structure your portfolio for that purpose, for me anyway, is just not, it's not worth the complications it's going to entail, particularly when you think about long-term investing. Unless you're putting large amounts in every single year, over time, most of your positions are hopefully going to be at gains. And so your tax loss harvesting opportunities are going to go down over time. And so what you'll end up with is a complicated portfolio with, I think, long-term limited tax loss harvesting opportunities. Again, there are always exceptions to that depending on your circumstances, but that's been my experience. So I don't personally find that a compelling reason to overcomplicate a portfolio, but maybe a decision you decide to make for your specific circumstances. So there you go. I always believe that keeping things as simple as possible is ideal. I do think there's good reasons not to go with just a single fund. But even if you want to take advantage of asset location and specific allocations between asset classes, for example, you don't really need more than 3 or 4, maybe 5 funds, and you can get a very well-diversified portfolio that covers the entire market, that is low cost and easy to maintain. So there you go. If you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.